Let's welcome in Diane Swonk. She's the chief economist over at KPMG. And I guess, Diane, the big question is, are we currently in a housing recession, or are we going into one?
I think we're already in a housing recession. The housing market is the most interest rate sensitive sector out there. And what's been so unusual about the run-up in mortgage rates is how rapid that run-up has been. And we know there's a lot of asymmetry in terms of demand when you have a rapid increase in rates. Happened over in the UK in a different way. But I think that's very important to understand, is that these rapid increases have really taken a toll on demand. We're going to be seeing the housing market the worst performer in the GDP data as it comes out for the third quarter, and going to be a continued drag from the second quarter on as we get into the fourth quarter and into 2023. I think we're going to continue to see double-digit declines in home sales and in overall housing construction. But as we get into next year, you're also really going to see the national pressure on prices, and that is despite still tight inventories. We've seen some of the hottest markets come off their highs in terms of prices, but you're going to really start to see a depreciation in housing assets. And even though that doesn't mean a repeat of 2008, 2009, this isn't a subprime crisis. A lot of people are locked and loaded on those low mortgage rates, and they have a lot of equity in their homes. It does have a wealth effect that will, I think, slow down the economy even further into recession, and we'll see a much more broad-based recession take root as we get into the turn of the year. So
Diane, is in this case here, is the housing and real estate economy a leading indicator for the rest of the broader economy? And I ask that vis-a-vis this point that the Fed has hiked interest rates markedly since the beginning of this year, and it seems like those interest rate hikes are starting to actually have a real effect on real economic conditions, certainly in real estate. So how long does it take for that real estate effect to happen everywhere else in the economy?
Well, that's obviously the million-dollar question or trillion-dollar question at this stage of the game. The Fed is clearly, at this moment in time, locked and loaded in terms of another 75 basis point hike and even another one after that, and potentially further after that. I do think they're going to have to stop around 4.5% on interest rate hikes, because they're also reducing their bloated balance sheet at the same time. And it's not clear to me that those won't have amplifying effects. That said, I think we're starting to already see some of the effect in overall consumer spending. Consumer spending in the third quarter is running at its coolest pace so far this year, and that's with the pivot away from goods, housing related, all the stuff we bought to deal with the monotony of quarantines, the pandemic-induced bubble we saw in housing, into services. And you can't replace services the same way. Of course, you can, a holiday party canceled due to the pandemic is not recouped. And I think that's important as well. But we're really going to see some real weakness as we get into the turn of the year from the consumer, I believe, as well.